Rebecca Babin of CIBC Private Wealth writing, the market may be overestimating the pace of production recovery while underestimating future inventory rebuilding demand. Rebecca joins us now. Rebecca, you're one of the few who are holding on to this view that maybe oil prices aren't going to go up. How much pushback have you gotten recently?
So I get a fair amount of pushback, but I would say this, you keep referencing the Morgan Stanley price cuts this morning. Guess what? Their targets are still above the strip, where the strip is currently trading right now. So $70 at the end of 27 is still above where the market has crude right now, which is closer to, high 60s. So I think what's happening is some of the analysts that maybe have overshot of where they thought crude would go are coming back to where the market is now. So in terms of the comment of what I'm making is essentially we are effectively pricing in all of this supply coming back to the market in a very even and measured way, and that demand, which has been impacted due to this conflict, does not come back, right? So that's what's being priced right now. And to me, that's just a little bit overly optimistic on how quickly the supply is going to come back. We've already seen fits and starts here, and we did have a lot of Iranian crude sitting off the coast of China before the sanctions were waived. So that was immediate pressure on prompt, right? And we've also had this SPR release which has helped buffer this conflict. So we've had a lot of prompt supply, and we're anticipating that this just carries forward in a very measured way, and that the demand drop that came out of China as they cut refinery runs, and transitioned away from some of their more fossil fuel intensive petrochemical activities isn't going to rebound. And to me, that's just a little bit pessimistic. If you look at the headlines today, China has already said they're going to roll back some of their product export bans. Immediately, that is going to pull forward a little bit more crude demand. And I think that we're overestimating the downside just as we had overestimated the upside at the height of the conflict.
So where do you see prices ending the end of this year, Rebecca?
So I think we can look at the end of the year, and I can kind of see Brent TI, I can see 75 TI, 80 Brent. And I just think that we don't necessarily see this even distribution of flows resumed through to 85. What I think is price is 85% of flows resumed by the end of July is what's priced. I think that might get pushed out. And we don't necessarily we are seeing this immediate reaction as ships have transited and Iranian sanctions have been waived. But if that gets pulled back, I don't think we see the acceleration of inventory builds that the market's anticipating. So I'm not drastically above the strip. I'm kind of looking 75, 80 Brent TI.
What do you make of the conventional wisdom that then next year we're going to potentially have another glut?
So that is a really interesting question. I think 2027 is shaping up to be really challenging from a forecasting perspective. Right now, estimates have a surplus of about 4 million barrels a day for 2027. Some analysts are higher, some are lower, but that's kind of the midpoint of the range there. That is going to be very indicative of how aggressively countries decide to stockpile after this event, right? If all of those 4 million barrels surplus is just kind of, we don't need to rebuild inventories and it's just considered to be excess surplus in the market, we could see pressure in 2027 and we could see the strip trend kind of closer to that $70 level in TI, maybe 65. I tend to think, having read the headlines again this morning, that India says they're going to increase their strategic petroleum reserves. China has some rebuilding of stockpiles to do. India also wants to diversify away from Middle Eastern crude. I tend to think that's a scenario we're anticipating this massive surplus, but what it's going to be is a rebuild, and the market might not reflect quite as loose as that number headline number would say. So I'm not thinking that we see this dramatic 60s, 50s crude scenario next year, which I know some analysts are pointing to. I tend to think we hover around this kind of 70, 75 level.
What has the OFAC waivers done for this market? The fact of the matter is Iranian crude could flow freely at market price.
This has been a huge factor, not just the OFAC, but the fact that you can transact in dollars, I think has opened up a lot of Iranian crude to the market. Now, what I haven't seen is a tremendous amount of buying outside of China of Iranian crude, but what that does essentially is make Iranian crude available to places like India, which has significantly reduced their imports due to the sanctions, and makes it a more competitive barrel right in the market that can press other things lower. Typically, Iranian crude traded at a huge discount because of those sanctions. It's now a free floating market barrel, and that kind of just can press things lower. Now, this all assumes we're talking about a 60-day waiver here, so we don't know how that shakes out and if it'll get reimposed. But for now, it's certainly the reason we're seeing the weakness in the prompt market, which I don't necessarily disagree with. When I look at the risk reward here, I think we've priced in a lot of a really optimistic scenario. And should that not play out, I think we have more upside than we do downside at current prices.